Hello, welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Management. Today's topic is goodbye or goodbye. Right? In other words, goodbye, like, get me the hell out, I've seen enough. Or goodbye as in terms, is this a good buying opportunity? Now, for those of you that are regular viewers, you know that for a long time I had the opinion or had the concern as whether or not our world leaders could lead flies to the manure pit. All right. But in the last couple of days, there's been a number of meaningful stimulus programs that have been proposed. Again, proposed, not passed yet. Largely, for the most part, they're not passed yet. They're still being discussed. But what's being discussed is meaningful, right? We're talking about packages that could be quite effective in remedying the effects here. So, does this mean it's a good time to buy the dip? Well, before we address that question, before we get there, we have to remember we just came off the longest bull market in history, right? The longest expansionary period in U.S. history. Before this, it was the 1990s, led up to the dot-com bubble. But we just came off 10 and a half to 11 years, depending on how you measure it. Just came off 10 and a half to 11 years where the thing to do was to buy every pullback. All right, that was easy. That was sort of the no-brainer. That's an expansionary period strategy. We're not in an expansionary period anymore. So the difficulty is, while we're still in that mindset, we have to realize that the rules of the game have changed. All right? It's much more difficult to buy the dip this time around. I want to give you an example of that. Right? What I'm going to show you here is the most liquid, or one of the most liquid ETFs in the world. Right? One of the most liquid ETFs in the world. Let's go take a look at that. All right, so what we're looking at here is a fixed income ETF. Right? This is iShares. This is a BlackRock iShares ETF of the U.S. bond market, right? It's only the U.S. Denominated bonds and only investment grade bonds. All right, it's a passive ETF. What does that mean? Well, they're not trying to beat anything, right? This is just a basket, right? An ETF is just a basket. It's just a basket, a way to trade a basket to get exposure to the entire U.S. bond market, the investment grade U.S. bond market. It's largely composed of three categories you can see over here, right? We got treasuries and agency debt here. We got corporate debt and then mortgage-backed securities. All right, one of the most liquid ETFs in the world. So you're asking yourself, Fat Man, why are you showing me this chart? Well, let's get down here. This premium to discount. Right now, this ETF is trading at nearly a 4.5% discount to the underlying assets. 4.5%. All right, so if you could trade all the bonds in the U.S., you would get 4.5% better pricing. All right, that's the easy way to interpret it. Now, why is that? Why is that? Well, you have to remember, in the bond market, when you have a cap-weighted index in the bond market, it's not like in the stock market, right? In the stock market, if it's cap-weighted, it means the biggest firms have the most weight, right? The biggest, most popular firms have the most weight. What does cap-weighted mean in the bond market? Well, it largely means the firms that have the most debt outstanding have the most weight, all right? That's not always a good thing. All right, so that's one thing to keep in mind. The second thing to keep in mind is the composition of the U.S. bond market, right? Over half of the investment grade bond market is in the lowest category. It's called the triple B category. It's the lowest level of investment grade. And right now, over half of all the bonds are in that category. And that's because these corporations have been taking on debt over the last few years to finance projects and to do other things like pay for stock buyback programs and so forth. And they've got themselves in a pickle, right? They've got leverage ratios that are very high, dangerously high, and that was going in to this downturn. That was going into this downturn. All right, so that's what's explaining why we're seeing that huge discount right now in the marketplace on that ETF. So let's get back to buying this dip mentality. All right, it's difficult, as I said, from a logistical perspective right now because of some of these discounts that we're seeing in the ETF markets. It's also difficult, though, because we're in this down channel, right? I think we're in this down channel. And even though I think the stimulus packages that have been announced, along with the tremendous central bank activity, I think that's going to be effective, right? I think we have seen the depths of the first down wave, right? Within this down channel that we're likely to experience, there's going to be a series of waves, right? Ebbs and flows. And I think we are near the depths of the first one. So again, does that mean it's time to buy? Well, logistics aside, we also have to realize that this is down channel, right? We got more to come. More bad news is coming. Now, I'm going to make a pretty strong statement here. I think what we've witnessed so far is the tremor. It's not the quake. All right, now I know I'm going to get a bunch of grief for this. A lot of people are going to call bullshit on me on this one. But I really believe we've just seen a tremor and not the quake. All right, to understand this down channel better, let's just review 2008, right? My understanding or my recollection of 2008 is there was essentially four waves of 2008, right? You remember late in July of 2007, we came back from July 4th weekend, right? We were all singing Kumbaya, the world is great, this thing's going to go on forever. And then late July, there was a little hedge fund called Sowood Capital in Boston that blew sky high. Turned out that was the canary in the coal mine, right? That was the thing that we should have been paying a lot more attention to. So it caused a fair bit of disruption at the time, again, in late summer of 2007. Caused a fair bit of disruption. That was wave one. And then things settled down. And then in February, March of 2008, Bear Stearns went under. You remember that? Well, Bear Stearns was taken over by, I believe it was Bank of America, right? They had to be handled. Let's just call it that. To me, that was wave two. And then wave three, at the end of the summer, early fall, we had Freddie Mac and Fannie Mae had to go into conservatorship. They went under. Conservatorship, that's one of those blue blood terms. It's a federal takeover. That's what it was. The government had to take them over. That was wave three, right? And then, of course, the quake, wave four, was Merrill Lynch and Lehman Brothers. When Merrill Lynch had to be taken over and Lehman Brothers went out of business. All right, to me, that was the four waves of 2008. So I think we have this series of waves coming, and we've only just experienced the first one. And I doubt it's even the most severe one, right? Again, the most severe one's likely to be the quake. So you're saying to yourself, all right, fat man, tell me, what is it you think the quake's going to be? Well, we've already touched on it. It's the bond market, the corporate credit market. We've got a ton of these triple B rated firms, right? And again, these are bellwether names, household names, the backbone of America. But these household names, a large chunk of them, they're going to lose their investment grade status. They're going to lose their investment grade status, I think. All right. And that's going to have meaningful consequences when it happens. And when they start falling, there's going to be contagion. All right. Falling begets falling. All right. So some of the other waves we're talking about, we are going to see this tsunami of earnings downgrades, dividend cuts, stock buyback programs are going to go the way of the dinosaur. The dinosaur, right? They're going to go extinct. We're going to see some of these other waves. But I believe the quake is going to be the bond market. So it's difficult. It's difficult from that perspective to buy the dip. But I do think we have seen the worst of wave one. I do think things are going to settle down here very quickly. Things are going to start settling down here. And, whether or not we try to take advantage of that or not. But the more important thing is realizing that this is probably just a calm in between the next wave that we're looking at. All right. So that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. Talk again soon. Thank you.